Picture this. It's 2001 and you're standing in a Buenos Aires bank lobby. The marble floor echoes with shouting. The screens above the tellers show the peso still officially pegged to the dollar, 1.1. But outside, on the street, that peg is dead. ATMs are spitting out insufficient funds notices, not because you don't have money, but because the government just froze withdrawals. You have spent 20 years building a business and now have the equivalent of $2 million in pesos sitting in your safe domestic accounts. You watch a man slam his fist into the glass at the teller window. His life savings gone in a decree called the Corralito. Overnight withdrawals are capped. Deposits converted to devalued pesos. Within months, the currency loses more than 2/3 of its value. He did everything right, obeyed the rules, trusted the system. In return, the system vaporized his wealth, and standing right behind him in the same bank lobby is another businessman. On paper, he's just as exposed. Same country, same currency. But this man walks back to his car and goes home worried, not destroyed. Why? Because most of his wealth was not inside that system. He had been quietly moving his capital into assets that didn't care what the Argentinian government announced on television. When the peso collapsed, those assets repriced. His net worth, in real terms, survived. Here's the uncomfortable pattern. In every major currency crisis of the last 100 years, most people are wiped out. A small minority walk through the same fire and come out the other side still rich. Not because they're lucky, not because they're smarter, because they own different kinds of assets. The topic nobody tells you until it's too late is this. When everything denominated in your currency is burning, what actually survives? I went through a century of financial collapses. Weimar Germany, Argentina 2001, Zimbabwe 2008, the global financial crisis of 2008, the Turkish lira meltdown, and Lebanon after 2019, and pulled the forensic evidence on what the already rich actually held. Not what they said on TV, what they owned on their balance sheets. By the end of this video, you'll know the 5 asset classes that protected millionaires and often made them richer, while everything else went effectively to zero. Stick with me. Before we dive into specific assets, you have to understand one brutal truth. Wealth destruction during collapse is not random. It follows a pattern. Governments get trapped, they spend more than they collect. They plug the gap with debt and money creation. The currency starts to wobble. Investors quietly leave. Then the public panics. On the surface, it looks chaotic, but at the balance sheet level, it's mathematical, and it always sorts assets into 2 buckets: claims on the failing currency, things the failing currency has to chase. Millionaires who survived positioned themselves in the second bucket. Let's start with the most misunderstood one. Asset number 1, monetary metals, gold and silver, the silent anchor. Go back to Weimar Germany, 1923. We've all seen the photos, wheelbarrows of paper marks, children playing with banknotes like confetti, but here's what those photos don't show you. A German industrialist in 1920 with 100,000 marks in the bank was middle-class wealthy. By late 1923, that 100,000 marks wouldn't buy a loaf of bread. The industrialist who left that sum in marks was ruined. Another industrialist with the same net worth, but who quietly moved a large portion of his holdings into gold, even at boring pre-hyperinflation prices, saw something different. As the mark collapsed from 320 marks per dollar in mid-1922 to 4.2x trillion marks per dollar in late 1923, the paper value of his gold skyrocketed in marks. Not because gold became magical, because the currency beneath it disintegrated. Measured in real goods, food, land, labor, his ounce of gold bought about the same basket before, during, and after the collapse. That's the key point. Gold didn't have to go up. It just refused to go down with the mark. Fast forward. Zimbabwe, 2008. While $100 trillion notes became novelty items on eBay, gold priced in Zimbabwe dollars went vertical. Those with bullion could convert ounces into foreign currency or local assets at fire sale real prices. In Venezuela's 2010s collapse, a simple gold coin could buy groceries for weeks when believer savings bought almost nothing. Millionaires who survived didn't treat gold as a trade, they treated it as balance sheet insurance. Why does this work? Because gold and silver are monetary assets, without counterparty risk. They are not promises from a bank or government. They are not someone else's liability. Their supply cannot be expanded with a keystroke. When a government prints its way out of trouble, the supply of currency units explodes. The supply of gold doesn't. So each unit of currency has to work harder to claim the same ounce. This is why during the 1970s stagflation, even as stock markets struggled and bonds were crushed by inflation, gold rose more than 400% from its mid-decade low in just a few years. In 2008, gold initially fell with everything else as leverage was unwound. Then, as central banks opened the money spigots, gold re-rated, climbing more than 150% from the panic lows over the next few years. Silver did even more. Here's what wealthy families do with this information. They don't go all in on metals. They carve out enough of their net worth into physical gold and silver, often 5–15%, so that if their currency is abused, a meaningful chunk of what they've built is anchored outside that abuse. No yield, no dividend, just silent resistance to debasement. While bank accounts and bonds are being rescued by inflation, their metals simply wait. Asset number 2, foreign hard currencies, the escape valve. Imagine you're a successful doctor in Beirut in 2018. You've saved the equivalent of $300,000 across 2 Lebanese banks over a decade, all denominated in Lebanese pounds. The pound has been pegged to the dollar at 1,500 for over 20 years, rock solid, or so everyone believes. Then, in late 2019, the protests start. Capital controls appear. The black market rate creeps from 1,500 to 3,000. By 2023, you wake up to a rate over 80,000 pounds per dollar. Nominally, your balance hasn't moved much. In real terms, it's lost over 95% of its purchasing power. What was once enough to buy an apartment is now barely enough for a used car. Now contrast that with a colleague, same profession, similar income, who distrusted the peg. Over the years, he diverted a chunk of his savings into physical U.S. dollar cash and offshore dollar accounts. He took a bit more risk storing physical bills. He accepted some friction sending money abroad. But when the pound imploded, his dollars didn't care. The same crisis. 2 doctors. One is effectively wiped out. The other has his purchasing power intact. During Argentina's 2001 crisis, the pattern was identical. Laws changed. Bank accounts were frozen or forcibly converted. Pesos were printed. The peso slipped from parity with the dollar to 1/3. Anyone whose wealth was inside the domestic peso system was trapped. Wealthy Argentinians who had already moved capital into U.S. dollars, Swiss francs, Deutschel, or euro-denominated accounts in foreign jurisdictions suffered inconvenience, not ruin. This isn't about the U.S. dollar being perfect or fiat currencies being holy. It'll ask about not having all of your claims denominated in the same fragile unit. Millionaires who survived collapse understood 3 things. 1. Currencies are relative instruments, or a collapsing currency can fall 90% against a basket of stronger ones. Simply being in a stronger currency preserves most of your real power. 2. Foreign accounts and physical cash are different animals. A dollar in a Beirut bank is very different from a dollar in a New York bank or in your personal safe. Location and legal jurisdiction matter as much as denomination. 3. Dollarization happens from the bottom up. When local money fails, people spontaneously switch to whatever holds value. In Zimbabwe, the street moved to U.S. dollars long before the government conceded. In Ecuador and El Salvador, entire systems rebased on the dollar. The lesson is simple but not easy. A portion of your wealth needs to sit outside your domestic currency and banking system before crisis restrictions appear. When the doors are closed, it's too late to leave. Borbord, asset number 3. Global cash-generating businesses, equities that benefit from collapse. Now let's talk about something that seems counterintuitive. You'd think stock markets in collapsing economies go to zero in real terms. Sometimes they do, but not always, and not for all companies. Look at Venezuela again. Even as the Bolivar disintegrated and local GDP imploded, the Caracas Stock Exchange, in nominal terms, exploded higher. Certain stocks went up thousands of %. Headlines called it the best-performing stock market in the world. Of course, measured in dollars, many of those gains were illusions. But here's the subtlety the rich exploited. A stock is not a piece of local paper. It is a slice of a real business. If that business owns real assets, land, factories, distribution networks, sells products abroad or gets paid in foreign currencies, can adjust local prices flexibly, then the collapsing currency simply forces its share price in that currency to reprice higher. The real inflation-adjusted value can remain stable or even improve. This is exactly what happened during multiple crises. Latin American debt crisis of the 1980s, Mexico's peso crisis in 1994, Asia's financial crisis in 1997-98, Turkey's lira devaluations in the 2010s and 2020s. Research on foreign direct investors and local firms showed a consistent pattern. Companies that earned a large share of revenue in hard currency from exports or foreign operations could see their local currency costs collapse in real terms while their hard currency income held steady. Their margins in hard currency expanded. Their equity holders, especially those who could convert returns into dollars or euros, preserved or even grew real wealth. Wealthy investors didn't just buy the market. They filtered for productive, globally connected businesses. Exporters with pricing power. Multinationals listed locally but earning abroad. Critical domestic monopolies that could raise prices with inflation, utilities, telecoms, where politics allowed. Meanwhile, purely domestic companies, selling only to local consumers with no export channel, restaurants, small retailers, service firms, saw their real earnings destroyed even if their stock price was up millions of % in the collapsing currency. During high inflation and collapse, nominal numbers lie. What matters is, what currency are the revenues in? What currency are the inputs and debts in? Can the business operate across borders? Millionaires who survived held substantial stakes in businesses whose economic life extended beyond one failing jurisdiction. Those stakes often sat in foreign brokerage accounts, listed on exchanges in London, New York, or Zurich, further insulating them from domestic financial chaos. So when their local market went no bid and their neighbors' savings evaporated, they still had claims on a Swiss food conglomerate, a U.S. software giant, a Brazilian exporter paid in dollars. Those claims remained claims on real global cash flows, not promises from a dying state. Arcadverse, asset number 4. Real assets that people must use, especially property with hard currency links. Not all real estate survives collapse, but certain types protect wealth better than almost anything else. Go back to the Great Depression in the United States. Urban landlords with heavily mortgaged apartment buildings in overbuilt cities defaulted left and right. Rents fell. Tenants couldn't pay. Banks foreclosed. But a subset of property owners came out intact, or even stronger. Owners of full productive farmland like grifos that could feed their families and communities. Owners of tenure prime urban or industrial land, in locations that would remain essential no matter what. Ports, rail junctions, resource-rich regions. owners whose land generated income in relatively stable money or in kind, food commodities. A farmer with a paid-off small acreage, a garden, some livestock, and a useful trade like carpentry or mechanics might have seen his nominal land price fall on paper, but he still ate. He could trade food, lumber, or labor for what he couldn't grow. His income statement survived even as others starved. Jump to Zimbabwe in the early 2000s. Commercial farmers once held some of the most valuable real estate on the continent. High-productivity land, export crops, sophisticated irrigation. In theory, this should have been the ultimate inflation hedge. Then the political regime decided otherwise. Land reform turned into outright seizures. Title deeds were ignored. Agricultural output collapsed. Land values were destroyed by decree. The wealthy who survived in Zimbabwe were often those who held property outside the jurisdiction. In South Africa, the UK, elsewhere. Structured ownership through entities that made on-the-ground seizure harder, focused on properties, whereas income was in foreign currency. Hotels paid in dollars, export-linked assets, or rentals to foreign companies. The pattern repeated in other crises. In Turkey, luxury real estate in Istanbul, priced in dollars or euros, saw owners protected better than those whose assets were fully lira-denominated. In Argentina, certain prime properties in Buenos Aires continued to be priced and transacted in dollars, even when official rates told a different story. Real assets that saved millionaires had three characteristics. 1. They were essential. Food-producing land, logistics locations, energy assets, or prime urban spaces that people must use in any scenario. 2. They were either unleveraged or lightly leveraged. Heavy debt in a collapsing currency can be a gift or a curse. When rates spike and incomes crash, forced sellers are wiped out. The rich who survived didn't depend on rolling cheap credit. 3. Their income or transaction currency was hard. Land that produced export crops, apartments rented to expatriates in dollars, warehouses leased to multinationals. This doesn't mean buy any house is a collapse strategy. It means owning the right land and structures in the right places, on the right terms, turns inflation from a threat into a tool. In every crisis, millionaires who survived had part of their net worth anchored in real usable assets that couldn't be printed and weren't easily taken. Asset 5. Human capital and private networks. The invisible asset the rich always count on. There's one asset class that never shows up on a brokerage statement, and yet it's often the most decisive in a collapse. Human capital and private networks. Look again at the comments from people who lived through hard times. My grandfather survived the Great Depression because he had a small 4-acre farm, carpentry, and painting skills. A physical skill in demand is an asset always. That's not just nostalgia. In every collapse, the wealthy who stay wealthy have more than financial assets. They have skills that translate across borders and systems. Medicine, engineering, law, logistics, software, manufacturing, even high-level sales and negotiation. They have networks. Bankers who will open accounts when others are turned away. Lawyers who understand cross-border structures. Partners abroad who can hire them, receive their capital, or help them move assets. They have optionalities. So, a second passport, residency rights in a safer jurisdiction, a business that can be physically relocated. During Lebanon's collapse, many of the remaining middle class were trapped. Their skills were local. Their language, credentials, and contacts were rooted in a system now failing. But a surgeon who could take exams abroad, speak another language, and had colleagues in Paris or Dubai could move and remonetize his skills in euros or dirhams. During Venezuela's implosion, those with foreign education, dual citizenship, or remote work skills in tech and finance could plug into the global economy while their neighbors were locked into a dying domestic one. For the already rich, human capital looks like seats on boards abroad. mandates from foreign investors, the credibility to raise capital internationally, the ability to advise, consult, or manage money across borders. When their home system cracks, they don't just sit in a burning building, they leave, physically or economically, and take their capacity to create value with them. If you look under the surface of any lucky millionaire who made it through crisis, you'll find some mix of gold, foreign currency, equities, and prime real assets. And behind all of that, the competence and connections to rebalance quickly when the ground shifts. That mix, financial plus human plus network capital, is what separates ruined in the bank lobby from setback but still rich. What went to $0 for everyone else. Understanding what saved millionaires is half the picture. The other half is seeing what destroyed everyone else. Across Weimar, Argentina, Lebanon, Zimbabwe, Turkey, and more, two categories show up as repeated wipeout machines. One, fixed income promises in the collapsing currency. Government bonds, local currency bank CDs, safe savings products yielding a few percent. In Weimar, bondholders were paid back in full in marks that were worthless. In Argentina, bond restructurings and forced conversions erased huge chunks of value. In Lebanon, interest on pound deposits meant nothing when the principal lost more than 95% of its real power. 2. Domestic savings inside the controlled banking system. Checking accounts, savings accounts, term deposits, all denominated in the local unit. When capital controls hit, withdrawals were limited. When devaluations came, conversion rates were political, not economic. When inflation accelerated, official interest rates lagged, sometimes by triple digits. These instruments shared the same flaw. They were acclaims on the failing system itself. Millionaires who walked through collapses intact understood that being a large creditor to a broken, panicking government is a terrible business model. They might have held some cash for short-term liquidity, but their core net worth lived elsewhere. Duanturs, how this applies now. You don't need to believe your country will suffer Weimar-level hyperinflation next year to learn from these autopsies. Currency crises are happening right now. Iraq has faced cash shortages and unofficial exchange rates diverging from the official. Turkey has seen the lira slide repeatedly, with citizens doubling their gold holdings in a single quarter. Lebanon has lost over 90% of its currency's value in a few years. Banks are technically insolvent, and even in countries that seem stable, the pattern of rising debt, political gridlock, central bank backstops should make any rational person ask, is it wise to have 95% of my life savings as a claim on one government and yes promises? The millionaires who will still be millionaires after the next round of crises have perfect timing. They won't predict the week of collapse. They'll simply be positioned. Part of their wealth in monetary metals that ignore political speeches. Part of their wealth in foreign currencies and accounts beyond one jurisdiction. Part of their wealth in global, cash-generating businesses. Part of their wealth in real, essential assets that humans must use. And all of that backed by skills and networks that let them pivot when rules change. They're not optimists or pessimists. They're pattern recognizers. History has already run this experiment hundreds of times. The data is there if you're willing to look. The question is not whether every currency will fail tomorrow. The question is whether your personal balance sheet is built like the average saver, concentrated in domestic promises, or like the people who reliably walk through crises still wealthy. If you want more of this kind of forensic breakdown, real collapses, real numbers, real positioning, subscribe. And in the comments, drop the asset from this list you're currently most underexposed to. Not to shame yourself, but to force clarity. Because when the rules of money change overnight, it's too late to start thinking about diversification. You'll either be the person pounding on the bank window or the one walking calmly out the door, knowing your real wealth was never in that building to begin with?